Welcome, curious minds, to another deep dive. Today, we're plunging into a project that's been making some serious waves in the crypto world. Hyperliquid. It promises the best of both centralized and decentralized finance. Aims to give us, lightning-fast trading, but with all the transparency we expect from blockchain.
That's right. It's a really fascinating blend of speed and transparency, claiming it can revolutionize how we trade. In this deep dive, we'll be looking at how Hyperliquid aims to pull this off, the impressive milestones it's already hit, and also the significant complexities and, frankly, risks that come with such an ambitious project. We've pulled insights from a whole stack of analytical reports to try and give you the clearest picture possible.
Okay, so before we get into what Hyperliquid actually is, let's start with the why.
Hmm.
What real-world problems did the founders see in crypto trading that made them think, right, we need to build something completely new here?
That's a great question to start with, yeah. Historically, decentralized exchanges, or DEXs, those platforms letting you trade crypto without a middleman they faced, three major hurdles, big ones, that really held them back. First, there was the issue of performance and high costs.
Right.
Think of it like trying to buy something online, but every single clip, adding to cart, confirming details, paying takes ages and costs you a separate expensive fee each time. Existing DEXs, especially those built on general-purpose blockchains like Ethereum, they suffered from really slow transactions and these high gas fees, making active, frequent trading just, well, impractical.
So if you were trying to make lots of quick trades, like a day trader might, those network fees would just eat up all your potential profit, wouldn't they?
Precisely, yeah. It was basically a non-starter for serious traders. Then there was the problem of capital inefficiency and limited functionality. Many early DEXs used something called an automated market maker, or AMM. Imagine trying to buy a rare item from just one big pool where prices are set automatically.
Yeah.
And the more you try to buy, the more the price suddenly jumps up against you. This led to significant slippage.
Ah, slippage, meaning you don't get the price you thought you would.
Exactly, especially for large trades, because there just isn't enough liquidity, enough stuff to buy or sell at your exact desired price. It forces your order to fill at worse and worse prices. And crucially, these AMMs, they just couldn't support the complex order types that professional traders rely on, like limit orders or stop losses.
Okay, so it was like trying to, perform advanced financial moves with only a basic calculator. Really limited what you could actually do.
That's a perfect analogy. Yep. And finally, the user experience was often pretty unsatisfactory. The whole process felt clunky. Multiple wallet confirmations just for simple actions. It was frustrating. A world away from the smooth experience on a centralized exchange, a CEX, like, say, Coinbase or Binance. But then things got critical. The collapse of centralized exchanges like FTX back in late 2022, that created a huge market vacuum and, maybe more importantly, a big ideological shift.
Right, the FTX fallout, huge deal.
It really highlighted the systemic risks of these opaque, centralized platforms. And it underscored this desperate need for an alternative that was transparent, non-custodial, meaning you control your funds, but still delivered high performance.
So what you're saying is they wanted the speed and the smoothness of like the traditional stock market or a big CEX, but combined with all the transparency and user control that decentralization promises. That sounds, it sounds like trying to combine two fundamentally opposing ideas, speed versus decentralization. How do you even begin to tackle that tall order without making huge compromises right off the bat?
It's a massive challenge, yeah. And that's exactly what Hyperliquid set out to tackle. Okay, let's unpack their core idea. Maybe a simple analogy helps here. Imagine if the New York Stock Exchange, right, where all the big stocks trade super fast. Imagine if that was actually owned and run by its users, completely transparently. And you could see every single transaction happening in real time, right there on a public ledger. That's kind of the ambition of Hyperliquid. Their grand mission, in their own words, is to encompass all finance on one single high-performance blockchain to create a fully open financial system.
Wow, encompass all finance. That's incredibly audacious.
Yeah.
So they're not just thinking about a place to trade, but like a whole financial ecosystem, totally transparent, built on this one blockchain.
Exactly. That's the vision. And to achieve that, they didn't just build an app. No, they built their own entire blockchain, their own layer one. Think of it like building your own superhighway, specifically designed for race cars, instead of trying to make race cars perform well on some congested city street.
Okay, I like that. A dedicated highway.
And this highway, it has two critical parts, and they're intertwined. First, there's Hypercore. That's the racing track itself. It's the optimized core of the blockchain, designed specifically for these native financial operations. It handles entirely on-chain order books for perpetual futures. Those are derivatives letting you bet on price without an expiry date, and also regular spot trading. Every single order, cancellation, trade execution, liquidation, it's all recorded transparently, instantly on the blockchain. No off-chain tricks happening behind the scenes. And the key insight there, absolute provable transparency for every market action. That's a massive trust differentiator compared to even the most transparent centralized systems.
Right. So they're building trust through absolute verifiability instead of just asking you to trust some central company. That feels like a really significant shift.
It is. Then there's the second part, Hyper EVM. Think of this as the SERDA station in the shopping mall alongside the highway. It's an execution layer that's fully compatible with Ethereum's virtual machine, the EVM. This is what allows other developers to build general-purpose smart contracts and dApps decentralized applications on Hyperliquid. The genius here, or at least the intention, is that this split architecture isolates the high-performance trading core from the potentially unpredictable load of all those other ecosystem apps. It effectively solves what they call the noisy neighbor problem.
Noisy neighbors, I get that. So other apps running on the system won't slow down the super fast trading part.
That's the idea. The insight is that by separating these functions, they aim to ensure the trading experience stays consistently fast and reliable, no matter what else is running alongside it.
Okay, so this architecture isn't just clever design. It sounds fundamental to making sure trading stays quick. A serious commitment to performance.
Definitely. And the engine powering this whole superhighway, it's their own proprietary consensus mechanism called HyperBFT, inspired by protocols like Hot Stuff. Now, a consensus mechanism, that's just how all the computers, the validators, and the network agree on the next block of transactions, right?
Right, they all stay in sync.
Yep. And HyperBFT is designed for extreme speed. They claim up to 200,000 orders per second. Transactions finalized in less than a second. Often the median is around 0.2 seconds.
Wow, 0.2 seconds. That's incredible.
It really is fast. It does this using a pipelined approach. Basically, validators can start working on the next block even before the previous one is fully finalized and agreed upon by everyone. The insight here is that it's not just fast, it's concurrent processing. It drastically cuts down the lag compared to traditional systems where you have to fully finish one block before starting the next.
That sounds incredibly efficient. But I'm used to hearing about crypto transactions taking minutes, sometimes longer. How do they manage the fees with all that speed going on?
Good question. Another huge innovation, or at least a big draw, is that users pay zero gas fees for placing, changing, or canceling orders.
Zero, right?
Zero gas fees for those actions. The operational costs are covered by the trading fees, which you only pay when a trade actually executes. The insight is that this makes the user experience feel much closer to what you'd find on a CEX. It removes a major friction point that you see on many other DEXs. They also use an advanced Oracle system. This is important for fair pricing, especially for things like margin calls when you need to add more funds and liquidations, when your position gets automatically closed if it goes too far against you.
Okay, how does that work?
Well, the validators publish median prices every 3 seconds, pulling data from multiple major centralized exchanges. This helps protect against short-term price manipulation on any single source. Crucial for keeping the market fair, you see.
Yeah, that makes sense. Adds a layer of protection against weird price spikes. What about other features? Is it just basic trading?
No, they also offer an innovative system of native vaults. This lets experienced traders create their own trading strategies directly on the blockchain, and then other users can invest in those vaults, essentially allowing for decentralized copy trading or asset management.
Oh, interesting. So you could follow a successful trader strategy automatically.
Kind of, yeah. The HLP, that's the Hyperliquidity Provider Vault, is a prime example. It basically acts as a market maker for the exchange. The insight here is it aims to democratize complex trading strategies, letting more people participate in sophisticated financial instruments. And to make it easy to actually get funds onto the platform in the first place, Hyperliquid has a cross-chain bridge. It supports deposits from over 30 other networks, think Ethereum, BNB Chain, Solana, and so on. This connectivity is vital for attracting liquidity.
Okay, that was a lot of tech talk, but I think I'm following the main threads. So they essentially built their own superhighway, dedicated lanes for lightning-fast trading. Other people can build shops and apps on the side roads, and actually trading doesn't cost you gas fees.
You've absolutely nailed the technical architecture.
Yeah.
But at the end of the day, all this clever engineering, it's designed to deliver something concrete for you, the user. So let's peel back those layers and talk about what these innovations actually mean for someone just looking to trade or use financial apps.
Yes, please. What's in it for me? Like, what are the practical takeaways here? Why should I actually care about Hyperliquid over other options?
Great question. Because it does offer several compelling benefits for users really trying to bridge that gap between traditional finance and decentralized finance. First, as we've said, blazing fast trading. You get trades executing in milliseconds, confirmed in under a second. The practical takeaway. Well, this is absolutely crucial for active traders who need quick execution, no delays. It lets you react instantly to market moves.
Speed is definitely king for traders.
Absolutely. And you also get cost-effective trading. Remember, no gas fees for placing or canceling orders. This means you can actively manage your trades, adjust your positions frequently without getting, nickeled and dimed by network fees every time you click a button. Big difference from many other DEXs.
Okay, so it's fast and cheap for managing orders. That's a great start for anyone, really.
Definitely a plus. And then there's full transparency and security. Every single transaction is recorded on the blockchain, fully verifiable, auditable by anyone. And crucially, you maintain self-custody of your assets. Your funds are always in your control, not held by a centralized exchange. The key benefit here is it removes that whole trust me element you have with centralized platforms.
Right, no counterparty risk like with FTX.
Precisely. You also get advanced trading tools, access to sophisticated features like up to 50x leverage.
50 times.
Wow. Yeah, 50 times leverage. Which means you can control a large amount of assets with a relatively small amount of capital. High reward potential, but also high risk, of course. And you get complex order types, things you usually only find on professional centralized platforms. This really empowers more advanced trading strategies.
50 times leverage is serious business, though.
Yeah.
Definitely not for the faint of heart.
Absolutely needs to be handled with extreme caution. For those looking for maybe slightly less active involvement, you can earn passive income and get discounts. You can stake the native HYPE token. Reported annual percentage yields, the APYs, are around 2–3%, plus you could potentially get up to 40% discounts on your trading fees.
Okay, so incentives to hold the token and participate.
Exactly. Creates incentives for users to be part of the ecosystem's success. And with Hyper EVM, there's also access to an expanding ecosystem. We're seeing a growing number of new dApps being built for lending, stablecoins, other financial services, creating this dynamic, interconnected financial environment. That means more potential opportunities for financial interaction beyond just trading. And finally, the platform boasts deep liquidity. Massive trading volumes, they say, regularly exceeding $10 billion daily, and cumulatively over $2.5 trillion now.
$10 billion a day, that's huge.
It is. And what that means for you is deep liquidity for your trades, which should mean less slippage. Vital for executing larger orders efficiently without moving the price too much against you. So what's fascinating here really is how Hyperliquid has managed to achieve this incredible speed and this pretty slick user experience. But if we connect this back to the bigger picture, it does raise a really important question. At what cost? These achievements, they come with significant complex risks. Risks you absolutely need to be aware of before diving in.
Okay. I was sensing a big but coming after all that impressive tech and the user benefits. Let's dig into that. What are the downsides, the potential pitfalls we as users really need to watch out for?
You're right to be cautious. Yeah, there are definitely significant trade-offs, particularly in areas that are, well, pretty central to the whole idea of decentralized finance. First, centralization is a critical concern, a big one. The system operates with a very limited number of validators. We're talking around 16 to maybe 21.
16.
That's it, 16 to 21. Which creates a high barrier to entry for new validators and, more worryingly, a significant risk of collusion or censorship among that small group. This is far, far fewer than the hundreds or even thousands you see on other major blockchains like Ethereum or Solana. And this centralizing tendency, it wasn't just theoretical. It was starkly demonstrated in that infamous jelly incident back in March 2025.
Oh yeah, I remember hearing about that. What exactly happened?
Well, essentially, this limited group of validators actually coordinated to halt trading on the Jelly token. And then they manually settled positions at a price that wasn't the market price to prevent what they saw as catastrophic losses for some participants. The insight here is profound and maybe alarming. It proved the protocol isn't truly immutable or censorship resistant. The administrators basically have a kill switch. They can intervene directly in the market. Imagine the New York Stock Exchange suddenly pausing all trading in Apple and deciding, okay, We're settling all Apple trades at yesterday's closing price because today's was too crazy. It fundamentally undermines the whole idea of a decentralized, trustless system.
Wait, so the people running the network, just a handful of them, could actually step in and change things if they felt like it. It sounds, well, a lot less decentralized than the marketing suggests.
Yeah.
And frankly, pretty unsettling.
It truly is a major contradiction. Next, security gaps are critical. Perhaps the most glaring issue here is a critical lack of public, comprehensive security audits for its core Layer 1 code and the DEX itself. A January 2025 report from Defense Safety actually gave Hyperliquid a 7% A rating for security, specifically stating that no audits could be found for the main software code.
7%. Fail. For a platform handling billions.
Exactly. The critical insight is, imagine a major bank handling billions, maybe trillions, in assets without ever getting its vaults professionally inspected or its security systems audited. It's unthinkable. Furthermore, the HyperBFT consensus algorithm, the very heart of their speed, it remains closed source. That limits external scrutiny and transparency. We can't fully see how it works under the hood. And being a relatively new Layer 1, it's also just less battle-tested than older, more robust blockchains. There have been reports, like in July 2025, of API reliability issues that actually led to trading halts.
Wow. Okay, that lack of audits is a huge red flag for me. Security should be absolutely paramount when you're dealing with people's money, especially on such a young and complex project.
Absolutely. It's a major concern. Then there are the high regulatory risks. This is another big one. The platform operates without requiring Know Your Customer, KYC, or anti-money laundering, AML procedures.
So no ID checks like on regular exchanges?
Nope. While that definitely appeals to some users for privacy reasons, it's a major, major red flag for regulators globally. And it potentially opens the door to illicit activities. There are already reports of law enforcement investigations, for instance in China, related to potential money laundering through Hyperliquid. The critical insight here is that this kind of non-compliance poses a potentially existential threat to the platform's future.
Yeah, regulators are definitely cracking down on that stuff.
They are. Plus, Hyperliquid offers perpetual futures. Those are derivatives. In many places, including the US, offering derivatives like that requires specific licenses. Agencies like the CFTC in the US have broad powers to pursue unlicensed activities. And the status of the HYP token itself is uncertain. Regulators, particularly the SEC in the US, could potentially decide it's an unregistered security. That could lead to severe legal consequences. Now, the project does try to navigate this by restricting users from the USA, Canada, specifically Ontario, and other sanctioned regions, but the overall regulatory threat remains very real.
So a lot of legal uncertainty hanging over them on top of the security and the centralization concerns. It really sounds like they're walking a very, very fine line with regulators worldwide.
Exactly, a very fine line. And finally, we need to talk about market and tokenomics risks. The project has an extremely high fully diluted valuation, or FDV. That's the theoretical total value if all possible tokens were circulating right now. Reportedly, it's exceeded $50 billion.
$50 billion for a project with these kinds of risks.
It's a huge number. And the insight there is it raises the question, is it significantly overvalued? Does that make the token price highly susceptible to volatility and sharp drops? Also, there are large planned token unlocks scheduled for core contributors. These start near the end of 2025 and continue through 2027-2028. This could introduce significant selling pressure onto the market as those insiders get their tokens.
The classic unlock dump potential.
It's a factor to consider. The platform has also shown vulnerability to whale manipulation, where very large holders can potentially influence prices, as we saw in that jelly incident. And while it does have a buyback and burn mechanism for its HYPE token, which is generally positive, a sharp decline in trading activity would reduce the protocol's revenue, impacting how effective that deflationary measure actually is. So to kind of wrap things up, Hyperliquid is undoubtedly a technological powerhouse. It really demonstrates that a decentralized exchange can achieve CEX-like speed and user experience right there on a blockchain. It's backed by what seems to be a highly capable team, has a strong community focus, and shows some really impressive growth metrics. It genuinely pushes the boundaries of what's technically possible in this space.
But, and it's a big but, it's crucial to remember this comes with significant undeniable trade-offs. Compromises in core DeFi principles like true decentralization and robust audited security. Plus, you've got those considerable regulatory and market risks hanging over it. It really is a high-stakes, high-reward experiment unfolding in the DeFi space. Makes it fascinating, but also, complex to watch.
This is actually a great point to quickly pause and remind our listeners of something.
That's right. If you're enjoying how we break down these complex projects into hopefully simpler pieces and you want more reviews just like this one, make sure you subscribe to our channel, CryptoBox. We do all the complex research so you don't have to.
Absolutely. So, Hyperliquid. It certainly pushes the boundaries of what's possible in decentralized finance, but it leaves us with this fundamental and I think quite provocative question. When the promise of blazing speed and user convenience clashes directly with the arguably non-negotiable demands of trustlessness, transparency, and true decentralization, which one ultimately wins? Which one matters more in the long run for the future of our financial systems?
That is a powerful thought to chew on. Where do those priorities lie? Well, thank you for joining us on this deep dive. We really hope this has given you a clearer, maybe more nuanced understanding of Hyperliquid, both the incredible potential and the serious risks. Keep learning, keep questioning, and we'll catch you on the next deep dive.